When we look over at the overall market here, though, of course, a similar kind of bifurcation coming when we look at growth cyclical stocks there as well. But I want to dig into that here with our next guest, Brad Neuman, Alger Director of Market Strategy, joins us right now. Brad, I mean, when we look into it, growth stocks are one of those ones that did get hit hard when we talk about inflation fears and risks there. But when you look ahead, how are you seeing that breakdown maybe reversing or otherwise here, as we are still seeing maybe the yield on the 10-year not necessarily spiking back to what we saw before?
Well, I think the market is wrestling with how strong the recovery will be and exactly how much inflation we'll have. And so, on any given day or week, the market kind of changes its mind. But in general, this year, we've seen low quality value stocks outperform. So companies with high levels of debt, high levels of operating leverage, low margins, and low long-term earnings growth generally outperform. And that's because those stocks are really sensitive to economic growth. And high growth, secularly driven stocks have lagged. But I think that the time is getting close to the low quality value outperformance coming to an end. And for growth stocks, which are becoming increasingly like a coiled spring, to surge again.
Can you elaborate on that a bit more, Brad? I mean, why do you think it is coming to an end? And if so, where do you put your money now?
Well, so, value stocks have priced in quite a bit of earnings recovery. Value stocks are up about 20% on a total return basis year to date. And growth stocks are up much less than that, more like 5%. But value stock estimates, such as revenue estimates, are trailing well behind not only their total return, but also that of growth stock. So growth stock fundamentals continue to grow double digits, but the returns are, very modest. And so they're getting cheaper, whereas value stocks have priced in a lot of the recovery. So when we look at, things like, low quality value cyclicals like the airlines having enterprise values just about equal to where they were before COVID, we think a lot of that good news and recovery is priced in those low quality value cyclicals. Whereas, as I mentioned, a growth stock that isn't going up much, but is growing, say, 20%, becomes 20% cheaper if the stock stays flat. So that's getting us more and more enthusiastic.
I also like the way that you're kind of talking about a mixed approach here and having your growth cake and eating the recovery too. And you highlight a few of your names that you like here: CoStar in the commercial real estate space and travel and leisure, also catching a play. Energy too. One of those areas we don't hear a lot of our guests talk about, but you kind of have to, given what we've seen play out in the oil market. So among those, I mean, which ones do you have the highest conviction on to be players that should be added in if you want to play both sides?
Well, I think it's important to have a portfolio of these stocks. As you mentioned, we think we can have our growth cake and eat the recovery too by investing in high return on capital, strong competitive advantage, low capital intensity growth stocks that also have exposure to recovering end markets. So in energy, which is notorious for having weak returns and poor shareholder value, we are able to find technology companies in that area like Core Laboratories, as you mentioned, which its mission is basically to enhance exploration and production through technology. And so it's a very, in our view, high return on capital company with strong competitive advantages in its technology. And so as drilling returns and exploration continues to ramp up, we think that there'll be a winner there, and we sleep well at night knowing that there's a long secular runway for growth in that company. Whereas we think investors who own some of these capital-intensive, low-return, low-quality value stocks are really just kind of renting them, and there's a lot of risk in that.
Brad, travel and leisure, another sector that a lot of investors are watching, especially because of the type of activity we've seen pick up, especially going into the summer travel months. What do you like there? And how do you sort of break down the travel names, especially when we have seen a pickup in activity, but also the challenges with limited capacity?
Well, so again, we would not be enthusiastic about the low return, high capital intensive travel plays like the traditional airlines or hotel, REITs, those kinds of things. We're much more interested in, the Expedias of the world that have what we think are strong barriers to entry, good long-term growth rates, high return on capital. Also stocks like HEICO, which provide supplies and maintenance materials and parts to the commercial aerospace market. We think that even though, as a lot of planes have been grounded, that maintenance has been deferred. And as people start flying again, that maintenance will come back, and those types of stocks will do quite well.
Brad Neuman, Alger Director of Market Strategy. Appreciate you joining us today.